Howdy, friends. Hey, I want to take just a few minutes to talk about our country's current debt load. Did you know we're currently carrying about $1.9 trillion of debt? That would include credit cards, mortgages, car loans, consumer loans, things like that. And of that, 1.2 trillion are just credit card debt. And some alarming news is that credit card debt has surged to its highest delinquency numbers in quite some time. Same goes with home loans and car loans. People are starting to struggle a little bit to make their payments. But something that's interesting is that the average homeowner currently has about $300,000 of equity. So something doesn't translate. And part of what it is that during the COVID crisis, when COVID was here in 2020 and 2021, people took advantage of refinancing to a very low interest rate, usually around 2.5% to 3%. Rates now are in the mid sixes, so a lot of people are not willing to give up those low rates. But chances are, with a credit card, you're carrying probably a 20% or higher interest rate. Car loans these days, it's not uncommon to see a payment of around $1,000 or more because of the short-term structure that car loans are at, usually a 5, 6, or 7-year term. And a lot of those interest rates are usually around 7, 8, 9, or even higher of a percentage rate. So in the years past, what typically happens when people get into some debt, they'll look at doing a debt consolidation, refinance, use that equity to try and pay off and pay off some of that debt and improve their cash flow. But for whatever reason, that isn't translating currently when people can do a lot to improve their cash flow. And one of the things that you could do, even if you refinance to a cash out loan, which now goes up to 90% of your home's value with no mortgage insurance, those are some options available to you, or home equity lines of credit, which are also a good option. But you can consolidate that debt, probably improve your cash flow by several hundred, or in some cases, over $1,000 or more per month. Well, if you take that payment savings, put it back into the mortgage, you're actually paying off your mortgage quite a bit faster than the 30-year term you'd be structured at. And your effective interest rate goes down because you're actually doing a much larger principal reduction payment each month with those payment savings. So consider that. If you need cash flow, that's a benefit in itself. But if you're looking to get out of debt quicker, you can consolidate those debts, take that monthly savings, apply it back to your mortgage, and then you're going to pay off your loan in just a few years. In many cases, 5 to 7 years, based on the payment savings and how much you're applying back as a principal reduction to your loan. So things to consider. It's not all bad news. Even if you trade out your 2.5% rate to a 6.5% rate, your effective interest rate goes down because of additional principal reduction payments and absorbing those high rate interest loans. And if you're thinking, I don't want to take a 5-year or a 6-year or a 7-year loan and put it into a 30-year loan, think about the tax benefits, think about the payment savings, the cash flow. Use that equity to help you. And as more and more inventory is hitting the markets, which is happening, home values are going to stabilize and may actually come down a little bit. So what that means is that $300,000 of equity that's available to you now may not be available to you in the near future. Even though real estate is a good investment and home values will go up over time, in the short term, you may see a reduction of that equity, and you may be missing an opportunity to consolidate debt and save yourself thousands and thousands of dollars in interest. I hope that resonates with you. I hope that's good information. Please reach out if you have any questions. DM me, text me, call me, whatever is your preferred method of communication, and I'd love to discuss options with you. Thank you.